There is something almost no one tells you when you cross a certain wealth threshold heading into retirement. The tax code changes, Medicare changes, the entire benefit structure shifts, and some of those shifts are not in your favor. After 25 years of sitting across from people who had saved carefully, worked hard, and done nearly everything right, I can tell you that crossing the top 10% in net worth is genuinely worth celebrating. But it also comes with a set of planning realities that most retirement content never addresses honestly. Today, we are going to define exactly where that threshold sits in 2026. We are going to talk about what actually changes once you cross it, and we are going to look at one specific compounding problem that quietly becomes the most expensive planning mistake wealthy retirees make, not in year one, but in year 10 and beyond. By the end of this video, you will understand not just where you rank, but what that ranking actually means for your tax picture, your Medicare costs, and your flexibility in retirement. That last word, flexibility, is the one I want you to hold on to, because it turns out to be the real difference between wealthy retirees who keep what they built and those who slowly hand it back to the system. Let us start with the number. So, where do you rank? Most people think of retirement wealth in terms of what's sitting in their 401k or IRA, and that's a reasonable place to start, but it's only part of the picture. According to Federal Reserve data cited by the Motley Fool, the top 10% of U.S. households by retirement savings had a median retirement account balance of around $900,000 and an average closer to $1.3 million. I want to pause on that gap for a second because it matters. Averages get pulled upward by the outliers, the people with $15 or $20 million in a single account. The median is the more honest number, and the median of the top 10% sits around $900,000 in retirement accounts alone. But retirement accounts alone do not tell the full story of your wealth. For many people approaching retirement, the largest single asset they own is not their 401k, it's their home. Studies consistently show that for older homeowners, home equity can represent the majority of total net worth. Nearly half of retirees describe their home as a major component of their wealth, and for good reason. When you factor in everything, retirement accounts, brokerage accounts, home equity, cash, any business ownership, the picture changes considerably. That complete picture is your net worth, total assets minus total liabilities. And based on Federal Reserve data, you generally need a net worth somewhere between $1.6 million and $2 million to rank in the top 10% of U.S. households. The U.S. Census Bureau's 2022 wealth distribution data pegs the 90th percentile at roughly $1.6 million. Other methodologies push it closer to $2 million. For the purposes of this conversation, and because we're focused on people approaching retirement, we're going to draw that line at $2 million in total net worth. That is the number, $2 million. Now, here's where it gets interesting, because how you got to that number matters enormously, and the path changes everything about what comes next. Think for a moment about where your net worth actually lives. Is the majority of it inside retirement accounts, pre-tax 401ks and IRAs? Or does a significant portion live in your home? Pull that picture into focus, because the next two sections speak to two very different situations, and one of them carries a planning opportunity most people never fully appreciate. If a significant portion of your $2 million net worth is tied up in home equity, here is something that genuinely surprised many of the clients I worked with at this wealth level, and I think it might reframe something you have been quietly worrying about. One of the most consistent fears I heard across 25 years of working with real clients was not running out of money in the abstract sense. It was one specific scenario: the nursing home, the extended care situation, the question of how you pay for something that can cost $8,000 to $12,000 a month or more, and whether that cost could undo everything you spent decades building. If a meaningful portion of your net worth is in home equity, you may already have a more powerful answer to that question than you realize. I think about a man I worked with years ago, Gary, 63 years old, recently retired after 34 years as a maintenance supervisor at a manufacturing plant outside Fort Wayne, Indiana. His retirement accounts held about $680,000, but his home, paid off, well maintained, in a neighborhood that had appreciated steadily, carried roughly $390,000 in equity. Together, he was sitting at just over $1 million in net worth. Not quite the top 10%, but the home equity piece was doing something important that Gary had never fully seen. Gary's hidden fear, the one he finally said out loud about 40 minutes into our first real planning conversation, was that he would need memory care someday, the way his father had. His father had spent his final 3 years in a facility that had cost the family nearly everything. Gary had watched that happen. He had never stopped thinking about it. What Gary had not done was look at his home equity as a planning tool specifically for that risk. He had been thinking about it as an inheritance, as a last resort, as something he would only touch if things got truly desperate. He had never thought of it as a self-insurance policy, already funded, already in place, that existed specifically to protect the rest of his retirement portfolio. Here's how that shift in thinking actually works. If you have enough home equity to cover 2 to 3 years of long-term care costs, and current national median costs for a private room in a skilled nursing facility run roughly $9,000 to $10,000 a month according to industry surveys, then you are not without a plan. You have a plan. You could sell the home when the time comes. You could draw on a home equity line of credit. You could use a reverse mortgage or some combination. All of those approaches can be structured to be highly tax efficient, far more so than pulling large sums from a pre-tax retirement account. And if home values continue to appreciate roughly in line with inflation over the long term, that equity tends to grow alongside the cost of care. Not perfectly, but meaningfully. The real gift of thinking about home equity this way is not just financial, it's psychological. When Gary understood that his home equity was already earmarked for that specific risk, that he didn't need his investment portfolio to solve that problem, he became a completely different kind of spender. He stopped holding back. He started living the retirement he had earned. That moment, when someone stops hoarding out of fear and starts actually using what they built, is one of my favorite things to witness. If that framing feels right for your situation, it's worth sitting with it seriously, talking it through with someone who can run the actual numbers for your household. Because for a lot of people at this wealth level, the answer to the nursing home question is already in their driveway. If a significant portion of your $2 million net worth is sitting inside retirement accounts, now, if most of your wealth is in pre-tax retirement accounts, the picture looks different, and this is where the planning gets both more complex and more important. There are two places where the system will treat you differently once your income rises above certain thresholds. The first shows up before age 65. The second follows you for the rest of your life. Before 65, if you retire early and need to purchase health insurance on the open market, ACA premium subsidies through the Affordable Care Act are tied entirely to your income, not your net worth. For a two-person household in 2026, premium assistance begins phasing out above roughly $86,000 in annual income. Above that threshold, you are largely paying full premiums on your own. What does that mean in dollar terms? For many healthy 60 to 64-year-olds at this wealth level, budgeting somewhere between $1,200 and $2,500 per month for health insurance until Medicare kicks in at 65 is a realistic planning assumption. That is real money, and it catches a surprising number of early retirees unprepared. The second place the system treats you differently is Medicare, specifically something called IRMAA, the Income-Related Monthly Adjustment Amount. IRMAA is a surcharge added to your Medicare Part B and Part D premiums based on your income from 2 years prior. It is not based on your net worth. It is based on income. And for retirees with large pre-tax accounts, income has a way of appearing whether you plan for it or not. At the base level, Medicare Part B runs roughly $185 per month per person in 2026. But once your individual income crosses around $106,000 or around $212,000 for a married couple filing jointly, IRMAA surcharges begin layering on top of that. At the higher income brackets, the total Part B premium can climb towards $600 or $700 per month per person. Here is why this matters specifically for people in the top 10 with large pre-tax accounts. Those accounts generate income whether you ask them to or not. Speaking of required minimum distributions, this is the part that most people at this wealth level only fully understand after it has already started happening to them. At age 73, or age 75 if you were born in 1960 or later, the IRS requires you to begin taking distributions from your pre-tax retirement accounts. These are called required minimum distributions, or RMDs. You do not get to choose whether to take them. You do not get to decide the amount is inconvenient or that you don't need the money right now. The distribution is required, the income is taxable, and the amount goes up every year. Here is the compounding dynamic that surprises nearly everyone the first time they see it laid out. Imagine you retire with $2 million in a pre-tax IRA. You're spending from your savings, but conservatively, say 3% per year. Your portfolio is earning roughly 6%. That means your balance is growing at about 3% per year net of withdrawals. By the time your RMDs begin at 75, that $2 million has grown to somewhere around $3 million. Your first RMD at 75 might be a relatively modest amount, perhaps $110,000 to $120,000. Manageable, not alarming. But here's the thing most people miss entirely. RMDs increase every year through two mechanisms simultaneously. Your account balance may still be growing, and the IRS divisor applied to your balance gets smaller every year as you age. Both of those forces push the distribution higher. By your late 80s and into your 90s, that annual RMD can climb well above $150,000 or $160,000, even if your personal spending has stayed completely flat. Now add Social Security on top of that. Add any pension income, and suddenly you're looking at a taxable income in your 80s that is significantly higher than what you're actually spending and significantly higher than what you planned for. Take a moment and think about this honestly. If you have a large pre-tax retirement account today, have you actually modeled what your required income will look like at age 85? Not what you want to spend, what you will be required to take. Those are two very different numbers for a lot of people. This is actually a good moment to step back and name what we're really talking about. Everything we have covered so far, IRMAA, ACA subsidies, RMD compounding, is all pointing at the same underlying reality. The system was not designed with you specifically in mind. The brackets, the thresholds, the rules, they are built around averages. You are not average. You saved more than 90% of your peers, and the system will treat you accordingly, in ways that are sometimes helpful and sometimes not. The question is not whether these pressures exist. They do. The question is whether you see them early enough to do something about it. What separates wealthy retirees who want to preserve their wealth from those who slowly lose it? The answer, in one word, is flexibility. If every dollar you own is sitting inside a pre-tax IRA, the system controls your income. RMDs tell you how much you must take. IRMAA responds to that income automatically. You did not choose that income, but you pay for it. Now imagine a different version of the same net worth. The same $2 million, but split across a pre-tax IRA, a Roth IRA, and a taxable brokerage account. Suddenly, you have something the first version does not. Options. You can live on $90,000 a year while showing only $40,000 of taxable income, drawing partly from the Roth, partly from the brokerage account, where long-term capital gains may be taxed at a lower rate. Same lifestyle, completely different tax outcome. That flexibility does not appear by accident. It is built deliberately, proactively, usually over several years before and during the early phase of retirement. The paths to get there look different for different people. For some, it means strategic Roth conversions in the years between retirement and RMD age, when income is lower and the tax cost of converting is more favorable. For others, it means opening or growing a taxable brokerage account earlier, a bucket that gives you access to capital without triggering ordinary income. For others, it means modeling what spending slightly more in your 60s actually does to your account balance and your RMD picture in your 80s. There is rarely a single right answer, but there is almost always a better answer than doing nothing. The insight that connects all of this, here's what I want you to take from today. And it's simpler than any of the numbers we have covered. Wealth in retirement is not just a balance sheet number, it's a structure. Two people can retire with identical net worths, both at $2 million, and end up in completely different financial situations 10 years later. Not because of the market, not because of bad luck, because of how their wealth was organized, which accounts it sat in, and whether they saw the pressure points early enough to prepare. The number got you to the top 10%. The structure determines what that number actually means for the rest of your life. If your net worth is approaching or above $2 million as you head into retirement, that's genuinely worth acknowledging. You have outpaced the savings of 90% of American households. That did not happen by accident. It happened because you made different choices, year after year, for a long time. What I hope today did was give you a clearer picture of the specific terrain ahead, not to create alarm, but to create clarity. The tax pressures are real. The Medicare thresholds are real. The RMD compounding dynamic is real, and none of them are unmanageable when you see them coming. Before you close this out, I want to ask you to do one thing, just one. Pull up your most recent account balance in your largest pre-tax retirement account. Then, ask yourself honestly, have you modeled what your required minimum distributions will look like at 80, 85, 90? Not what you plan to spend, but what you'll be required to take. If you haven't done that yet, that's the most useful 3 minutes you can spend this week. If something in today's video clarified something you've been sitting with, I would genuinely like to hear about it in the comments. What clicked, what raised a question, what surprised you? I read every one. And if someone in your life is working through these same decisions, a spouse, a sibling, a close friend who has been saving carefully and wondering what it all actually means, send this to them. These conversations are always clearer when you're not having them alone. My name is Clara Morgan. Thank you for spending this time with me. I'll see you in the next one.